Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to answer a question that someone asked on Twitter. I'm going to give you my financial opinions around it. Obviously, it's just my outlook, my paradigm of how I view the markets, and it gives you a little bit more information on how I invest from a strategic standpoint. I'm very much strategic. I am not tactical. All right. What is the difference? Tactical is seeing something in the markets and reacting to the market. Strategic means you're looking for certain patterns and behaviors to align. And then once things start to align, you start to deploy money at opportune times in the best and cheapest sectors for the best risk reward. That's what I'm doing. So let's dive in. Let's take a look at this question here. So the question is, as the ratio of uranium price to minor equities worsen, will sellers hold out for an even higher price as liquidity in the market worsens? Because raising money from the market is much less attractive. Good to great flywheel. So this is a short-term market event that is driven by humans, partially by humans, and how they respond to problems in the market, partially. Liquidity is, I'll say, given or supported, however you want to say it, by the Federal Reserve to some extent. So they are very powerful, and they can change their decision and minds at a whim. So what I look for are the big overall trends, the big long-term, big picture view trends. So he's talking about this here. He's saying as it worsens down here, it's a very cheap price in terms of URA, which is an ETF, versus the underlying commodity futures pricing. It's at a very cheap ratio. This ratio goes up for the most part during an inflationary increasing interest rate environment. That's generally when it goes up. So think of inflation. If you think we're entering an inflationary environment, I definitely think this is going to go up. And I think it is much less driven, I know this sounds weird, by the supply and demand of the individual commodity itself. Although that helps, it's not solely driven by that. It's driven by the money rotation between the S&P 500 and bond market. That is why we see commodity bull markets, and all of the commodities participate in these bull markets. That is why we've seen them occur under these periods here. Those are commodity bull markets. And those commodity bull markets are driven by money rotation from the S&P 500 and from the bond market, choosing and selecting assets that outperform during inflationary periods. That is what matters more. You need money to move out of other assets and rotate towards your asset. Now, during this time frame, uranium was in a surplus. During this time, uranium was in a surplus. And both of those commodity bull markets for uranium price went up dramatically. Now, if you can look, these two bull markets are not the same. This one occurred under a declining interest rate environment. This one occurred under an increasing interest rate environment. The intensity of this bull market for commodities was very intense. This one, it was intense, but it wasn't as big. And the money rotation wasn't as large. Now that we've got a breakout of interest rates coming and has broken that 40-year downtrend, that is what's going to cause a more intense move, in my opinion, into commodities, because a lot of money is rotating out of bonds, and it's going to be looking for a home. And it's going to have a profound impact on the S&P 500 because the S&P 500 and the NASDAQ have not been repriced to the interest rate level that we're at today. This is what happened during an interest rate environment. It went down for the S&P. It went sideways to lower. That's going to happen here. It's going to go sideways to lower for the SPX versus producer price index with the interest rates going up. So when you talk about liquidity, that is a short-term effect. That is something that is not measured by, this is a 40-year decline. You're talking about liquidity that measures in like a slice of a year or 6 months or 3 months. The natural cycle here is broken on the big long term. So the way that I view these markets is I'm taking a position. I took a position down here and I'm riding it all the way up. And the way that I identified this is the ratios were cheap, the demographics in the real estate cycle were coming into an expansionary phase, and that's when everything aligned where I thought this was going to break that downtrend line. And then we're going to see a big rotation of money occur. A big rotation. We may even see people question the bond market in its entirety. And all that money has to then go and flow into something else. So when I look at uranium, when I look at the question here, this is what I said. The ratio tells us if something is cheap, which uranium equities are cheap. The next question is, what market condition does this ratio change under? And when will the right market conditions come to change this asset pricing? Given history that occurs under a rising interest rate environment where money rotation rotates towards energy equities in general. The timing is now, in my opinion, but the granularity of this statement is measured in years, not weeks or months. In the short term, there could be pullbacks in the markets from other conditions that occur during a rising interest rate environment. So what does that mean? Well, when we come back and we look at this breakout, there's been a long area where we've had very cheap interest rates. As interest rates go up, I don't think they're going to go up straight. We could see a move or we get a pullback. This pullback is where things get flushed out of the system. It's a cyclical pullback in a secular move. A secular move is the big move in interest rates and the big move in commodities. The secular traits are these pullbacks that occur in the markets. They're shorter term. They might be 3-6 months in duration, maybe even up to a year. We could have a recession, a drawdown, a pullback. I think where people get hung up is they try to time the market in the short term. And I think it's really difficult to do that. So what I do is I play the big secular move, the big change, the big 2020 bottom all the way up. And I accumulate on dips. Why? What does that do? It offloads all the short-term noise. It just says, you know what? Just ride through it. Ride through it. Go through it. Now, newer investors, they think that they can time this stuff. They're going to say that's a bad approach. Don't do that. Why are you going to try to? Why wouldn't you get out before a recession? Well, yeah, if I knew when a recession is exactly going to hit, I would get out. Yeah, if I knew, but no one knows. No one knows when the recession is going to come. We can look at the yield curve. It can uninvert. But what if oil doesn't go down during that time frame? What if it's an inflationary recession? What if we have a bond problem, a bond crisis? What if they do QE to solve it and everything just rockets back up? Why not just stay in the asset if the big secular move is that asset? Well, I don't need to sell. There's no reason for me to time a short-term pullback in the market. I don't understand why everybody's trying to time the short term. I don't understand it, guys. What you guys are telling me, or what I read in Twitter and a lot of these people, a crash is coming. I'm going to time the crash. Okay, let's look at history here. Let's just say you're in the S&P 500. We've got the S&P 500 here, okay? The big secular trend in the S&P in 1980 80 and 82, you should have been buying stocks right here. The big secular trend is up. All right? You could have sold out for this, bear market there. That's about it. What you guys are trying to time is you're trying to time, in my opinion, like this is what I'm playing. I am playing this move here to here. That's the move I'm playing. I'm playing this move here to here. That's the move I'm playing. So I would have bought in 82 and sold in 2000, and that would have been my holding period. Now, what people are trying to time is these small market movements that occur inside of these moves. So they're trying to time this move here. They're trying to time this move here. They're trying to time each and every one of those moves in the short term. I'm going to try to time this little market pullback here. All right. But guys, I mean, if I open up the TNX and I go to a new pane, why would I time that move? Why would I do that? We have a decline in the interest rates the entire time. Stay long equities until you can swap somewhere on this side over here. Why try to time that? I don't get it. Now, I can understand timing the, maybe over here coming into a expansionary phase of real estate and not wanting to play that. I can understand that. I don't understand when people are trying to time these little moves over here. And then every time they try to time the move, these guys get crushed. They get mispositioned and they miss the big move to the upside. Oh, like this was so bad to live through. It was September of 87, October was the crash, and then November. And it took about a year or two to come back to that peak. Okay, so what strategy could I develop? I purchased, I started purchasing here. I rode it all the way up. It got sold off, and I bought more down here. Then it goes back up, and I don't. Draw a line across. It breaks to the upside up here. I buy more in 91 as it breaks that pattern. There's the pattern. It breaks to the upside. I buy more in that other circle, and I just keep holding on. And I get more rich and more rich and more rich, and all of a sudden I'm a I got tens of hundreds of millions of dollars up at this spot. But you know what? I was stupid because I didn't want to sell out for that little move that lasted for 1 year. For 1 year or 2 years, where I had to go down and I had to go back up and wait. All during a declining interest rate environment, which the big secular move was to the upside for the S&P 500. I don't understand that viewpoint, guys. All of the richest people in the world, you know what they do? They hold on for the long term. Warren Buffett, Peter Lynch, Jim Rogers played the whole commodity bull market. Why wouldn't I do that? I don't understand the viewpoint of these guys trying to time the short term. So we have all these people trying to time the short term. Oh, there could be a pullback here. I don't care. Interest rates are going up. They're in a completely new paradigm, guys. Look, it's broken. It's done. In fact, you know what? You could draw the line here. And this was a breakout, a retest, if you really want to get technical on it. And this is the move higher. This is the big move that's coming on interest rates and inflation. Now, if everything that I look at ratio-wise is cheap, if it's all cheap, if this is basically the trigger of commodities outperforming stocks, I mean, look at it. Does that look the same, if not the same here? It's the same thing. If there's a bond market crisis and interest rates are going to 7, 8, 9%, 10%, commodities are going to rip it. Why would I swap and sell my things? What options? I'm curious, guys. What options if I sell my commodities? Where am I going to go? What other assets am I going to go into? Am I going to go to dollars? No, I don't want to be in dollars. Am I going to go to bonds? No, I don't want to be in bonds. Okay, then where am I going to go? If people are leaving the bond market, if people are going to leave the stock market, where are they going to put their money? Where is this crash going to occur? Let me let you in on something. it's going to crash against commodities. That is what's happening. So you know where I want to be? Commodities. I want to be in precious metals. I think precious metals are going to do some ridiculous things here. Question is when? And I think it started. I think it started. So the trend of interest rates is going to reprice assets in this market. And I think people are worrying too much about the short term. You have to come to terms with the time frame that works for the market. Time frame doesn't matter what you think. Take what you think, throw it in the trash. All right? You need to adopt whatever the market is adopting. You need to adopt a winning strategy in the market and the time frame that the markets are going to allow you to make money. Did that take me a long time to figure that out? Not really. Because I just sat down and said, I'm going to do whatever it takes to make tens and probably maybe even hundreds of millions of dollars. How do you do that? What is the recipe? And that's what I'm focused on. How do I make that type of money? And what I came to the conclusion with, and I'm an engineer, I worked in the 9 to 5 camp. I'm not going to make that type of money working at a 9 to 5 job. My efforts focused on trying to become a better engineer is not going to make me tens of millions of dollars. It's not going to happen. And I figured that out quite early. So what did I do? I focused my efforts on trying to make my money through investing. Then I have to adopt whatever the market is going to tell me. I have to change to what the market is going to allow me to make money. I have to have the psychological fortitude to hold through pullbacks, short-term little cyclical pullbacks in a big secular bull market. I need to learn from the best. Well, what did the best do? They hold through everything. They take long-term, long time frame approaches. They identify value. I'll say they identify misallocations of capital in the market and identify where the value is based off of the market conditions. So right now, everyone's pinned in financial assets. That is what the market conditions basically awarded since 1982 from this decline in interest rates. So the decline here, I don't know why this got chopped off. I don't know how that happened. The decline in the interest rates for TNX. Oh, I know why, because it only goes back to 19, whatever. Here, I'll pull it up this way. The decline in interest rates, this decline here is the reason, if you were to put it up, is the reason why stocks went up like that. That's the reason. Now that that has changed, you need to adopt a different strategy, a different paradigm. Stocks are not the strategy in this paradigm. Commodities are. Gold. And all you have to do is just stay long those things. And as long as those sectors possess traits like double bottoms, inverted head and shoulders, which they all do, we should be long those things. And all of the ratio charts of commodities to financial assets are positive for commodities. So I don't understand the viewpoint that someone's going to try to time the very short term. Oh, there could be a pullback. I don't know, guys. Like, I'm going to ride through it. Buy the dip. Accumulate more capital if you think that's coming. Keep your positions on, is my opinion. Ride on through it. If we're in an increasing interest rate environment, money's going to continue to rotate. And you're not going to time every single small little pullback, in my opinion. I think it's too difficult. Get the big picture right. I'm up 10, 20 times on some of my positions. 10, 20 times. I think some are going to turn into 100 baggers. All I have to do is wait. And I guess that is the hardest thing. It is very, like Jesse Livermore's book, Reminiscences of a Stock Operator, very rare for people to be right and to be sitting tight. And you know what I'm going to do? I'm going to do absolutely nothing. I'm going to continue to add to opportunities that arise. Now, picking individual companies, there are certain things I look at now. I'm not looking at how high they are off of their highs. Or how low they are off their highs. I'm looking at fractals and patterns and people that are accumulating certain companies. Then I'm measuring the fractal sizes. That's how I'm doing it. Then I pick the companies. Then I'm going to ride those companies. And that's how I did it off the bottom of March of 2020. I purchased a lot of my stocks in September, October, November of 2020. That's uranium and oil, and I've been buying ever since because I continue to make money and I got to deploy it somewhere. And I'm across a bunch of different sectors. So that's how I'm doing it. And if you want to know what stocks I'm buying, go to the website and take a look. I have my whole portfolio up there. You can see exactly what I own. Some of them are up dramatically. I don't put the percent increases that I'm up. I just say that I'm overweight these companies. Some of them I'm overweight because of when I bought them. That's how I'm doing it. And I'm still continuing to look for opportunities. Gold and silver they're cheap, guys. They're so stinking cheap. There's going to be a huge opportunity there. Huge. If gold replicates anything like it did in the 1970s, some of those stocks are going to go dramatically. And oil, there's opportunities in oil. There's opportunities all over the place in commodities. Uranium is going to do the same thing. It's going to go ballistic to the upside. We're in an increasing interest rate environment. It's going to be much like the 1970s. When uranium was in a big surplus back then. The equities will have their time in the sun. Just be patient. It'll come. The market conditions are there for that to occur. Now it's just being patient because we're still rotating money from the old paradigm. People still believe in the old paradigm of stocks and bonds. That paradigm needs to get crushed, which it will. Money's going to rotate differently in the system, and it takes time for that to occur. It takes losses for those in the bond market. It takes losses in the S&P 500. It takes lessons to be learned for this money to rotate. Just be patient. The people who adopt it quickly are already rotating over. Now it's the other general public that really needs to get hit, and hurt for that money to rotate over into our area. All right, guys, that's what I've got for today. Thumb up for the content, subscribe to the channel, and we'll catch you guys next time. This is Finding Value.